So the FTSE is up 0.5% this week, but the main moves have been in the currency market, and that's been stimulated by the Bank of England not cutting rates. So again, the market was caught out because they expected a rate cut, and when the rates weren't cut, we saw quite a big rally in sterling. Here you can see over the week we've gone from 129 to 134 on cable, and although that's a relatively small move compared to where we were pre-Brexit, it's a big move off the bottom. Perhaps if we delve deeper into the minutes, it's less conclusive, and I think what we're seeing is a delay in that easing through from July over to August, by which time they have a bit more data. They have the August inflation report on the 4th, and at that point I think the market still expects rates to be cut to 10 basis points, which is the floor effective lower bound, as it's called. We'll probably also see a signalling for QE at that point. So in the minutes we also saw a couple of interesting sound bites. There was general concern about the significantly lower activity in the housing investment market, and the prospect of sizable falls in commercial property were noted. But they were encouraged by the new Prime Minister's appointment, market stability and bank stability in their funding costs. So as a result of that rally in sterling, we've got quite a big rotation in terms of the performance in the FTSE. Key performers were the domestic stocks. The prospect of less likely rate cut helped the domestic banks, Lloyds being the biggest contribution to performance in the FTSE this week. And some of the defensive US dollar earners gave back a bit of their performance. So here you can see the names of BATS and Shell and Diageo and Unilever, which have been the real stalwarts in a risk-off, strong dollar environment. So both of those catalysts subsided. We're also sort of looking at the correlation with foreign stocks to GDP and strength. So just picking out a few of the names, Johnson & Johnson, Medtronic, are negatively correlated to sterling. So as sterling weakens, you get a stronger share price. So that gives you a geared effect because you're also getting gains on the currency. If you want to hedge that position, Walt Disney is the inverse of that, and then you've got a whole list of uncorrelated names that we still like on our buy list. It wasn't just the sterling dollar rate that was moving. We've seen very big moves in the yen, which has weakened this week by around 5.5%. That sent the Nikkei up 6%, and that's on the basis of this expectation of further fiscal easing and helicopter money, which is basically the central bank directly financing the government in terms of their fiscal ambitions. That has been prompted by Ben Bernanke visiting Japan and speaking to the Bank of Japan. We've still got problems in terms of nervousness about banks in Europe, and the CDS, or the cost of insuring debt for Deutsche Bank, continued to rise over the week and gain headlines. It's now back to where we were in 2011 in the Eurozone crisis. The IMF labelled Deutsche Bank as the world's systematically most risky bank. And I think we just continue to keep an eye on this as a better proxy for tension or issues in Europe than the peripheral spreads, which are obviously being suppressed by ECB buying. The week ahead is extremely busy. There's a huge amount of names that I won't go through on that list, but just picking out two, we've got Amazon this week. We are continuing to see good growth on the retail side. They're penetrating more into grocery and clothing. Just to give you some quick stats, they now have around 45% of the market in clothing and online, and the online market now accounts for around 52% of clothing sales in the US. We've also seen Amazon Web Services in their last quarterly report 70% year-on-year growth with a 17% margin, so it's going to be really interesting to see what comes through from them. And J&J is also reporting they've been extremely strong year to date. They're up 6% since Brexit because of that correlation to sterling, and also the defensive nature of the stock. But it's not just that. They've got a great pipeline, particularly in oncology. They've got an extremely strong balance sheet with 16 billion of net cash, which we think they will put to good use. With good opportunities in the consumer side of their business. So that's it for me. Thanks very much.